Welcome to Retirement Ramblings. I'm Scott, and today is day 334 in my countdown to retirement. Well, today is going to be an information packed day, and I'm going to apologize right up front because I'm going to need to look down a considerable amount of time to make sure that I get the information that I want to share with you correct. But today I spent a bunch of time updating my Boldin retirement plan. And so I'm going to walk you through a variety of assumptions that I make in the plan and hopefully be able to explain in this video exactly what I'm doing and why I'm doing it. And I look forward to your comments and questions at the end and via email should you have any, anything you want to ask me about as to why I'm doing what I'm doing. So to start off, first thing this morning, I downloaded my portfolio data to check how we, ended the month of January. We ended the month up 2.59%. Not as good as the S&P, not as good as the Russell, not as good as the Dow Jones Industrial Average, or the moderately aggressive benchmark that I compare myself against each month. But we did beat the Nasdaq, but only because of the DeepSeek fallout that happened earlier in the week, and then in the last couple hours of Friday with President Trump doubling down on the tariff discussion with Canada, Mexico, and China, and the market sold off at the end of the day. So that hurt. But in any event, got the information that I needed. Then my wife, at the end of each month, she updates our expense tracking spreadsheet that I created for her, and then also a net worth tracking spreadsheet. And when I say I created them, I did, but it was basically in a format that I could then use to leverage what I'm doing in Boldin, so I can take the information that she puts in there and fairly easily migrate it into the retirement plan that I manage. So she got that for me together. I then used that in the retirement plan, updated all of the values that we have in there. And then I went out and, wanted to revalidate a variety of the rate assumptions that are used in the plan because they have a dramatic impact, on the Monte Carlo simulation values that the plan, gives you at the end. So basically, I started looking at the overall inflation value, and I used 3.8% for my optimistic value in Boldin, along with 6.61% for my pessimistic value. And then Boldin, for average, splits the difference between those two values and, any other optimistic and pessimistic values. So all the averages are really just, 50% of the difference between the two of those, or the average of those two, I guess you could say. These values were taken from the U.S. inflation calculator with values by month that go back to 1914. And then I used the values from 1961 to present, because that correlates to my lifetime. And the average rate of inflation over my lifetime has been 3.8%. And the minimum inflation rate over my lifetime has been 0.35%. The highest was 13.58%. And I'm using the median value between those two values as my pessimistic assumption. So, and then since 1914, the peak inflation rate was 17.81%, and that occurred in 1917. And there was a couple of other kind of peak values that I just didn't want to include. So anyhow, that's how I came up with my overall general inflation rate. Yours, what you choose to use obviously is up to you and may be different, but I at least want you to know the sources of the information so you can go back, check the value yourself, come up with whatever values you think are appropriate, for you. And I guess I should say, I'm not a financial planner. I'm not a professional at this. These values all relate to me, So the disclaimer is do your own due diligence, and you make the value decisions for yourself. And just assume that I'm telling you all this information for entertainment purposes, but you need to do all of your own due diligence in all seriousness, in your plan, and don't rely on necessarily the information that I'm sharing for your own assumptions. So then moving on to the medical inflation rate, I'm using 5.22% for my optimistic rate and 9.56% for my pessimistic rate. And these values, again, were taken from the U.S. inflation calculator, which goes back to 1948 for tracking healthcare inflation. And again, I use 1961 to present for my values. And the average healthcare inflation over that period was 5.22%. The maximum healthcare inflation was 12.12%, but I excluded 4 years that were above 10% in my calculations, and that was 1975, 1980, 81, and 82. So the early part of the Reagan, end of Carter, beginning of Reagan time period. And so by doing that, that reduced the maximum rate to 9.56, and I made that my pessimistic value. And then for Social Security COLA, I'm using 2.6% for my optimistic value and 0% for my pessimistic value. You can go to ssa.gov and they provide the yearly breakdowns for COLA that go back to June of 1975, which is the first year that COLA was tied to a CPI. Prior to that, it was only handled via legislative action. But starting in 1975, it was tied to the CPIW. So the maximum COLA rate was 14.3%. That occurred in 1980. The minimum was 0. That occurred on 3 separate years since 1975. And the average COLA is 3.75%, with the median being 2.95%. I excluded all the COLA years above 5%, which there's 11 of those. And then I took the median, which becomes 2.6%. And that's what I'm using as my optimistic value. And then for the housing appreciation rate, I turned to the Federal Housing Finance Agency to look at the peaks and the valleys. So peak appreciation occurred in July of 2021 at 19.1%. Peak depreciation occurred during the financial crisis in November of 2008, when housing prices fell 10.5%. And according to Griffin Funding, the historical long-term housing appreciation rate is approximately 4.27% from 1967 to 2024. I went and looked up data from New York University, and they track asset classes by decades, and going all the way back to the 1930s. So using their data, the average appreciation across the decades from 1930 to 2024 was 4.74%, with the worst decade averaging negative 1.2%. So those are the values that I decided to use for my optimistic and pessimistic assumptions. So the median appreciation rate has been 3.9%, and that excludes, and if you exclude 2 boom periods, it drops to 3%. So then I also looked at data from NYU on stock, bond, and cash annual returns from 1928 to 2023. And stocks averaged 9.8%, bonds averaged 4.6%, cash 3.3%, real estate 4.2%, gold 4.9% during that period, and the inflation rate throughout that period was running at 3%. So net to play conservatively in my plan for my asset mix, and I know you'll disagree with this, but for my asset mix, I'm using an optimistic return of 6.57% and a pessimistic return of 3.4% across my long-term stock and bond portfolio, and an optimistic rate of return of 3.64% and a pessimistic return of 0% across my short to midterm portfolio, which is cash and cash equivalent instruments. So, um, you know, given, like I said, that the stocks average 9.8, bonds 4.6, you could blend out whatever ratio you want based on, are you at 60 40 50 50 70 30 80 20, whatever your mix happens to be. But for myself, I'm going to use 6.57% as what I actually expect to have happen over my retirement, and obviously I can tweak that as time goes on. I've also planned a number of significant one-time or recurring expenses that relate to home maintenance and the like, such as replacing a hot water heater every 10 years, replacing an HVAC system every 12 years, replacing the major appliances in our house after we've lived here for 15 years, replacing a vehicle that we're just about to pay off after 12 years, repainting our home every 10 years, and putting on a new roof after the house is 20 years old, and then funding special milestone events and bucket list trips. They're all included in my plan. So the only thing that I have yet to include in Boldin is Roth conversions. And the reason for that is I ran the Roth conversion estimator tool in Boldin, and for me, it doesn't really show a significant improvement in my particular portfolio configuration. So that may change. I'm still playing around with it and trying to figure out, what exactly it would do for me relative to taxes, relative to, legacy amounts that are left at the end of my lifespan. But right now, that's the one area that, I've yet to flush out. So when I run the plan with both my optimistic and average assumptions, Boldin indicates I have a very high probability of success to not outlive my money and to have the type of retirement that my wife and I, have been saving and planning for. Only in the pessimistic scenario does Boldin show I have a very low probability of success. And given that, planning is only a point in time exercise, should things go awry while we're retired, obviously I can make adjustments, to hopefully bring up that probability of success. But even with the probability being poor, it really we get most of the way through our projected lifespan to like the last 2 years of our life, based on our estimates, even in the pessimistic scenario. So I have a high degree of confidence currently that the plan is in a good place, but I am going to actually contract with Boldin coaches, I guess they're called, to review the plan, make sure I didn't do anything stupid, and that I haven't forgot to include something in the way that Boldin handles the calculations. So kind of that's what's happening in Boldin. I want to just show you here though what Boldin's informational notes are to me for the optimistic, average, and pessimistic scenarios. And you'll note that in the optimistic scenario, Boldin estimates that I'm only going to be withdrawing at a 2.9% withdrawal rate. When I go to the average scenario, that increases my withdrawal rate to 3.5%. And then in the pessimistic scenario, it shows that I'd be withdrawing at an 8.1% rate, which is why I guess it's showing that I would fail, right? So I'm not following the 4% rule, but clearly if I'm under 4%, and you know, that is the traditional thing that people try and stay under, although my plan isn't structured for that. But the fact that I am in two of the three scenarios staying under 4%, I guess, is the reason why I have a high chance of success. That being said, when I'm in the optimistic scenario, I pay the most taxes at 10.5% effective tax rate, which I still think is super low. So I'm good with that. At the average one, it's 7.6%. And then in the pessimistic one, it drops to 5.2%. And uh, even on the IRMA calculations, the only time I get an potential IRMA charge is really when either my wife or I die. We get a, what do you call it? You get a life insurance payout. So it's a lump sum payout that goes above the IRMA limit. So, for the next 2 years, which we only expect to, one of us only expects to outlive the other by 2 years anyway. So we'll have 2 years max of IRMA that we'll have to pay if the plan holds water. All right. So kind of switching subjects real quick from Boldin, while I was out getting the information that I just shared with you, I came across a Gallup poll that I found really interesting that indicated, so they compiled this data from 2011 to 2024, and it's U.S. adults answering the question, what do you regard as the best long-term portfolio investments? And I got to say, I was surprised by the answer because I was expecting it to be stocks and bonds because, that's what everybody talks about with regard to, your portfolio, whether you believe in a, you know, 1, 2, 3 stock portfolio, whatever. That's generally what people are talking about in combination with like a pension. What it shows is that um, the highest thing is real estate, which is then followed by stocks and mutual funds, which is then followed by gold, and bonds are near the bottom, just above crypto, which just got added in 3 years ago into the study. So I just found that kind of really interesting, and I'd like to know your thoughts on it. So, like, what do you think is the best long-term investment? Do you concur that it's real estate? And is that, if so, is that a major part of your retirement plan? Meaning, your house and the equity that's built up in the house, is that what you're relying on as a key component of your retirement plan? Or is it some other mix that's, that you're looking at? In my particular case, even though the house is included obviously in our overall net worth, it's not one of the things that I'm looking at for any kind of cash flow. I mean, clearly, if I run into problems, I can sell the house, get the equity that is built up in the house, and then potentially rent for the rest of my life or whatever. But that's not currently in the plan. So the equity in the house is not one of the things that I'm looking at to make our plan successful. So I'm just curious if that's one of the things that you're looking at. Anyhow, that's what I've spent my entire day on, is working on the Boldin update, doing all the research, and flushing out all of our numbers now that January has, come to a close. Again, if you have any questions, any comments, please leave them in the comment section down below. If you want to send something to me one-on-one, please send me an email at myretirementramblings@gmail.com. I hope you have a great evening. I appreciate you watching this, and until tomorrow, take care.